Welcome to the podcast and video as well. Paul Hill joining me, of course, equity analyst, full-time investor. He's there, as always, on the markets. Let's talk about it first, Paul. The big news out yesterday, of course, in the UK was analysts didn't forecast as high an inflation rate and CPI as came out. 10.1 came out. I think, what was the prediction? 9.8, was it? Something like that?
Yeah, I mean, it was fairly similar, wasn't it? It was slightly higher than expectations, but we're still in double digits, back to sort of like 1982 levels, sort of 40 years ago. So, yeah, it's pretty hot.
And the bonds moved. I mean, you're a bond market man. The bonds moved yesterday, didn't they? 2 year went up by 10% or something ridiculously.
Yeah, I mean, I think basically the Bank of England now is baked on to push the interest rates up to, up another sort of like 0.5% at the next time over. Then they'll take it at, was it 2.25% if they put 0.5%? I think it's 1.75. So what you've got really is the UK and Europe still struggling with inflation, largely orientated because of the Ukraine-Russia conflict, which has pushed energy prices up, and the US actually is probably reaching peak inflation. We just saw that in July. Theirs came off slightly. So I think what the market is, the market's rallied hard on the back of it. The last 2 or 3 weeks, and it's largely because of the tail risk in terms of a really hard, sort of like economic landing, or even, really tough recession. I think that's been taken off the agenda now of investors, and we're looking for sort of like a more of a softer landing. But yeah, I mean, central bankers are likely to continue being relatively hawkish in terms of increasing interest rates to get to sort of like a level that they can get then comfortable with inflation. But I'm still reasonably optimistic. I think inflation will come down over the next sort of 12 to 18 months, particularly if we get some nice little tailwinds, if there's a ceasefire in Ukraine and Russia, if China decides actually to implement a proper vaccine program to be able to protect their population against Omicron, and we get some rain in Europe, because that's pushed up food prices, and also, power costs in terms of hydro in Europe, and also, nuclear. So if you got 3 of those things happening in the second half, it would totally change it. What's your sort of view of equities over the next 6 to 12 months?
I think there'll be a lot of downgrades on companies, in certain sectors, and that's why you've got to pick wisely over the next, 6. I mean, just looking at some reports yesterday, they're saying that the interest rates now, they're saying that 13% target is looking optimistic on inflation. Some forecasts say, who knows? They didn't get it right last time, but they're saying interest rates could double from here. I think companies and people have been squeezed on both sides now. Borrowing costs gone up, everything. Cost of living has gone up, and so spending is going to go down. And it's going to hit a lot of employees in companies. And there was a lot of tweets looking at just businesses and the energy costs. Ridiculous. There's reports of 5-fold increases, and I've seen some doing 10-fold increases. I don't know how small business is going to cope with that. And of course, that's going to have a knock-on effect. And there's been reports saying whenever inflation has basically gone above 9%, it's taken years to come down. And it's very sticky. I don't think it'll drop off a cliff. So I think we'll have these, it's funny, just American markets. It's probably the peak inflation thing, just rallying on that, it's come under forecast. But when you think of it, 8.5% inflation is still high. It's still going to have a knock-on
but I mean,
impact.
at least a third of that is just straight energy and food, isn't it? And largely because of the Ukraine crisis. So that would drop through pretty damn quick. And certainly on base effects, if it comes down from current levels, then that's going to have a huge impact, because it's obviously elevated. And then you've got the rest of it usually comes on the lines of, indirect inflation from food and energy, as people push up their salary costs, and also rent goes up because housing, has gone up in price, but that's sort of coming off. I mean, all I would say is that I don't think there's been that much difference in economic outlook over the last 2 or 3 months. In fact, if anything, I think it's slightly improved. When you say inflation is high over 8. Well, we've known that for ages to a certain extent.
Yes,
the Bank of England's been saying inflation expectations is going to hit 11-12% for 6 months.
Yeah, but we know a lot of people don't. The general public, I don't know. I mean, you and I, of course, we look at headlines every day on financial, business blogs, papers, articles. the general public, honestly, it's kicking in next quarter of the year. Obviously, the caps are going up. There's estimates now of 4,400 for domestic users. In fact, I've seen today from City AM saying 5,600. That's not kicking in yet. The biggest costs are not yet kicking in, and especially the businesses. We have no cap, so it's not kicking in. So, I mean, if you talk about companies reporting, of course, that's a lag effect as well. Companies reporting on results with these costs baked in, it's going to take a while to kick through. And like I said, Ukraine, hoping for, everyone wants that to end, the Ukraine crisis, but I don't think it's going to stop overnight. I mean, if you look at the Donbass region, they've been warring there since what, 2008, 2014? It's still going on. So it may de-escalate a little bit, but I can't see Putin just stopping. So that's going to be around for a while. So yeah, I'm just saying, and right now, and it's not too late. I think it's time to sort of look at your stocks and say, okay, in the next 6, 12 months, even over the next 2 years, who's going to face headwinds here? Who's going to be squeezed and who's not?
So what are you doing with your portfolio? Have you been buying or selling anything at all?
Yeah, I've eased on most of my stocks, apart from 2 pretty much, and that's
you've eased on it. You've sold.
Well, yeah, I've reduced on just top slicing, most of my stocks, and put
so which ones have you top sliced? Presumably XP Factory. Then if that's a consumer face.
XP, I've top sliced for the GFin. What the other one's too illiquid, but I've basically put them towards.
So you've top sliced 2. You've top sliced 2.
Hang on, bear with me. Let's have a look. Yeah, because the others at the moment, they just. I mean, I see them undervalued. Things like Biome, I see is undervalued because it's going to come out this year with good results. A player in it did a while back anyway. GTC, I top sliced that because I still believe in them but I think timing is a little. It's going to be pushed out a little bit. I mean, the growth driver for Getech is green hydrogen. They're not going to start generating revenue till 2024, but they're not overvalued. So, but I've put some more into eEnergy and Trufin. Trufin was the target, of course, is invoice financing. I think they'll be very busy. I think they'll start kick in with Lloyd's. They start to commercialize that in Q4. And eEnergy, if you look at what they're doing, they just brought together 4 parts of the business and consolidated that. And if you look at the last 2 quarters, they've hit record revenues in the last 2 quarters, and it's only just starting to happen now. And you can see how busy they are. And so I think going forward, I think if anything, I think they'll upgrade on revenue and top line there because, like I said, they're rushed up their feet. They've got so many businesses now worrying about energy bills. It's the biggest input cost. It's the biggest rising cost for any business. And many of the small businesses, which they don't target, they target companies above who spend more than $250,000 on energy a year, are going to suffer. They're going to go through. And I think once they start seeing these bigger bills come in, they'll have to start taking action. So, and other companies as well. In fact, like Crestchic, people like that.
Just before we move on to Crestchic, in terms, what's your cash holding now then?
Cash holdings probably it's not a lot. I mean, I'll take money out of one and put it into the other. So
so you've just rotated, have you?
Yeah,
so when you say not a lot, you mean what, less than 5% or something?
Yeah, probably less than 5%. Yeah.
Oh, okay, right, fine. So that's just normal sort of day-to-day liquidity, isn't it?
Yes. So no, I'm not. I mean, there's 2 ways to look at this. Okay, I'm ultimately a bit bearish over the next 6 to 12 months on companies that are not insulated or won't benefit from eEnergy, all that kind of stuff. But I still believe in them. But I think I eased up a little bit on the holdings, because I think there will be some headwinds. And I think in the American markets are insane. They're rallying like 20% off their lows. That's a technical bull market. And I think, hang on a sec. And if you look at the charts and look back to the great financial crash, there's been lots of overlays recently of saying this is a classic, bear market rally, and it will probably roll over and go lower. I think it will. I think the markets will go lower. Not a lot though. I think we've had the biggest fall, but I think we haven't found a bottom here. This is just a bear market rally, I think.
Yeah. Well, yeah. I mean, that's quite interesting because you were more bullish, weren't you, last time when we spoke? I mean, I'm still pretty positive, but you're sort of like turning a bit more negative, aren't you?
Yeah. Well, do you know, I've it's very handy in this day and age. On social media, you can actually follow industry and people in industry. And I've been following some people, businesses and hospitality industries and all this, and just looking at actual reports from businesses saying, this is our energy bill last year. This is it right now. And literally, there's one guy there went from, I think he owned quite a good restaurant in London, I think, but he was showing his energy bill last year. It was like, I I think it went up to doubled to 8,000, and now he's looking at an estimate of 25,000. And I think that's unsustainable for many small businesses, and they're not alone. And the worrying thing is, there's no energy cap, for small businesses. So when is that going to drop off? It's not, I mean, energy prices are not going to drop off a cliff. It's going to take a couple of years to bring it back down. And even the Bank of England said, 2 years we'll probably get back to 2%. I think maybe, but it's. I mean, getting from 5% to 2% is probably harder than getting from 9% to 5%. But I still think it'll be elevated for several years. So. Yeah, it's. I mean, there's plenty of. There's plenty of sort of time, and we are at the bottom. How much is priced in? I don't know. No one knows that. A lot is priced in. I think. But I think we still have a bit more fear to go. Really.
Let's hope we get a resolution in Ukraine and Russia, and then that would make a massive difference. So fingers crossed.
I think that would be amazing if that happens. But I don't know if it is. When you look back at it, the war's been going on there. I think back as far as 2008. So, of course, there's a big escalation in that last year. But
people were saying we're never going to get a vaccine in 10 months, and we did. So, you never know your luck with it.
Yeah, that's a different, it's a completely different thing, isn't it? People were yearning for a vaccine, and money's going into that, and everyone wanted that. This is like a rogue dictator state. Annex,
anyway, just moving on to stocks. You interviewed one of the guys one of the companies that I've been following, Saietta, which does the effectively EV type or style electric motors, inverters, and systems and stuff like that. Well, how did you get on with the old CEO Vic Kist?
Yeah, good. Vic is. I like him a lot. He seems like he's one of the guys. Is a workaholic, and he gets things done. I like talking to him. You can see he's a genuine fella, and he's got a vision there. And I do like this company. I mean, if I had spare cash, and I think I'd wait a little bit to see how the market plays out over the next 6-12 months. But it's definitely a company I consider investing in. Like I said, it's a growing end market. They seem to have an excellent product there, and now they've got this big deal signed up with ConMet. Which is going to
out in the US, aren't they?
Yeah, in the US, a big supplier for some manufacturing trucks and all that stuff. And so, yeah, I think it's going to go. I mean, and if I suppose it helps having broker forecasts and notes, seeing what the perceived growth is going to be. And it's going to be very impressive if you go by the broker. Like I said, top line 3.9 million for this year. That's gone up from 900K, and then to 21 million next year, 2023, and then to 61 million the year after. And now, they are one of the 150 million market cap. So, there's a little bit of price in there. But I think beyond that, it could be even more impressive, if they get these end marks. So I like them, and I like what they're doing. I like their product.
Yeah, I think that
very professional outfit,
Yeah, I mean, that ConMet deal could we absolutely sort of he's groundbreaking, but could be revolutionary, transformational for them in terms of creating those e-hubs for trucks and trailers out in the States, and it's a massive addressable market. And I think ConMet are the number one providers out there in the US as well. So you can't go with a better have a better endorsement that for Saietta's technology there. And I could see them quite easily actually doing those numbers you've just quoted. So and what was also quite interesting was the directors participated in the placing to fund that deal in terms of working capital and development, and also accelerated the rest of the business model. I mean, if nothing else, it's really tough to get a placing away at the moment, and they've managed to do it at a higher price than when they IPO'd originally. The directors have participated, and it was for ended up to 23.6 million pounds. So it wasn't insignificant either, and that just shows you how good the technology is, and the sort of the quality of the fund managers who have also put money into it. So I'm with you.
That's the thing. Is I did say to them, I said, well done for getting raising money away in this market, and only 3% discount is like, that's not heard of. But what I like as well, when I look at companies like this in hot areas, I also want to know they're going to be profitable at some point. Not just growing top line, but they say they are. EBITDA forecast be EBITDA profitable in 2023, and then that's going, 300k, but that's expected to go to 12.2 in 2024 and be adjusted. Pre-tax profitable of 9.4 million in 2024. So that's, to me, that's a good sign. They are.
Yeah, Canaccord have got a price
Yeah.
target, which I think is modest, of only £2.75, and that was before the Conmet deal. And I think they'll probably
yet, have they? Yeah.
Yeah, and so I think that was a great, absolutely brilliant agreement that, as I say, really rubber stamps that technology. And when you partner with such an industry leader like those guys out in the States, it just says everything really about the quality of the business and the management team at Saietta. The hard bit, obviously, is going to be ramping it all up and developing it in fast. Fast.
Yeah.
In fact, that moved me on to the one before, I left and stuff, before I went on holiday. I've only come back yesterday, so I'm sort of getting my head around the actual markets. But Crestchic, I interviewed the executive chairman, Peter Harris, before I went on holiday, and these guys do load banks and mainly which was used to test backup power supply systems and stuff, and they've upgraded their expectations for the third time, but this was a significant upgrade. And I've pushed my numbers up to about 10 million of EBITDA on 40 million of revenue, and that revenue growth is 35%, and it's backed up basically by really strong demand right across the patch, across regions, and in certain verticals like particularly data centers and renewables and grid stability. But as I say, right, in the US, the UK, Europe, Asia, the Middle East as well, it's all coming back in terms of these large projects. And the major growth driver is on the rental side, which is the high drop through, sort of like profit drop through rate. So EBITDA drop throughs are very, very attractive in that area. The sales are good, but the rental side, the hire equipment is fabulous. So huge.
So give us an example of, their kind of clients, their customers, who are they?
Well, it can be lots of different people. So they sell or they rent particular properties. So let's just say, for argument's sake, Amazon has got a data center. It's just pushed. It's got a generator in their backup power supply because the reliability of the grid goes a bit wobbly. They want to buy a particular load bank, which is often the case because it's absolutely mission critical, and therefore they need that to basically commission that data center, but also ongoing test it as well to make sure the power supply generated from that, basically the UPS or the backup power supply they have is correct. So when the network goes down, that they can actually continue working on that data center. And then it could be, it might well be a hospital, or it could be a fire station, it could be a company, it could be even sort of like an oil and gas business who's off grid, haven't got their own, they just run their drill rigs off their own independent power supply, and therefore they need to have those tested and serviced using the load banks. So that's the kind of thing. And the load banks also not only do the electricity, but they also do the heat, simulations as well, and there's things like data centers. And it's all just absolutely firing on full cylinders at the moment, right across the patch. And when it comes to valuation, I'm still sort of like the highest valuation compared to most of the other analysts out there. But I'm at £3.30, and I think that's modest because it's only a 10 times EBITDA and a business that's growing revenues currently at 35%, predicated on strong demand and increasing capacity. So when you put that all mix, I can see this one going well above £3.30 in the fullness of time, and the shares are moving up on reasonable volume at the moment. People are starting to realize what a strong business this is in very, very good high demand areas with an excellent management team.
Yeah. Well, that's from, talking about the moment, just looking at companies like this, because there's been lots of rumors of blackouts happening, isn't there? And the gas prices at an all-time high. There's lots of worries about power supply and stability and all that. So that plays into that. It's analyzing companies over the next 6-12 months that are going to be almost benefit from where we are at the moment. And let's be honest, this is largely energy induced inflation, so it's playing into that sector. Who benefits from that? and looking into that, and Crestchic and other, my stock, eEnergy, is the same kind of thing. They benefit from high energy costs. So yeah, and that's it. No, I do like them. And in fact, you know what? I remember looking at them. I think you first mentioned them on this thing a while back. I thought they
over 2 years. I've been banging the
Yeah.
table about those guys, and Equals for the last 2 years has been my number one picks.
Yeah, well, I remember looking and saying they seem very reasonable, and I remember looking at them, and just looking at I think the initial top line, looking at their revenue and their market caps, and oh, there we are. And then I think within a couple of days, at a trade update, and they jumped by 26% or something. Oh, there we are. The market's starting to realise. So that can happen. There are plenty of opportunities out there that the market hasn't caught on to sometimes, haven't they? So cool. What's next then, fella?
Yeah, I would say. I mean, what also I caught up with the guys at Mark's Electrical, who are the online retailers of all things sort of domestic appliances. Mark Smithson, the founder and CEO, and Josh Egan, the CFO, and they're just knocking the ball out of the park compared to the rest of the market. I mean, they said that their first 4 months had seen trading like for like up nearly 14%. They're on track to hit EBITDA, profitability, their profit expectations for the year. They've got a solid balance sheet. Will have net cash at the end of the year as well. And their brokers have got sort of like a £1.20 price target. And when you compare that to the sort of the poster child of this whole sector, of AO World, I mean, they're predicting their sales are going down by 15%, and the market for this area is actually struggling in the UK. So these guys are winning market share hand over fist because of their great service, their proposition, and their price points and what they do. So you've got to hand it to these guys. It's the strong get stronger, and if you're going to basically invest in certain businesses, you go with the best management teams, the best business models that continue to win market share, and they've absolutely accelerated their market share. I mean, it's gone from sort of like 12 months ago, 1.5% of the sort of overall major domestic appliance market to over 2%, 2.1%, which is a phenomenal increase. And it's even a bigger increase of market share on the online side. So, these guys are doing a really good job. And they're beating they're winning market share from AO World, from John Lewis, and from Currys, and all these kind of guys. And these aren't insignificant companies. And to do that is really good. And the ultimate vision is to take the market share up to 10% from 2%. And if they do that over the next 5 years, you'll see a huge re-rating in the in the shares. It's a classic baby in the bathwater at the moment. The sentiment to retail and consumer is very poor, particularly for this area. And the shares have been, knocked back. So those guys are doing I mean, if you think about it, to make, if you're AO World predicting they're going down by 15% in terms of sales for this year, but you've got Mark's Electrical increasing its sales by 14% and the market down by 20% or 15-20% in the first first 4 months. I mean, it just shows you how good that proposition and how it's just chiming with consumers and repeat customers.
Yeah, but it's true, like you say, sentiment wise, the gains, stocks like this, retail stocks and hospitality leisure stocks, but they will rebound, and if they do rebound and you want to take a bit of exposure, you've got to go for the best, because they'll rebound the strongest. So you're not just going for any old, online retail or that, go for the best one. And like I said, Mark's is a family business. I always like owner operated. Like I said before, that book about where a guy analyzed 100 baggers, he said there's not a lot in common really, but one of the things underlying is owner operators feature quite prominently in the big returns, because they have passion for their business, don't they?
Oh yeah, but they're very capable, and they've demonstrated that they can actually deliver over numerous cycles. I mean, these businesses have been going since the 1980s, 1990s, and they've already been through tough times. They know what they need to do in the levers, and they're still been growing. So really, really good, really impressive. I did.
Hang on a sec. Go on. I was going to say then we haven't mentioned, which I've seen in most read RNSs on Vox the last 2 days, is Boohoo and REVB.
Yeah, I was going to think, I own obviously shares in Boohoo, and now indirectly I own shares in Revolution Beauty. So that's great. I mean, I actually think it's a very, very sensible tie-up. I mean, just to recap, Boohoo have just sort of snapped up almost, I think it's 12.9%
Yeah.
of the share capital of Revolution Beauty. They both service the younger consumer demographic with sort of beauty, cosmetics, and fast fashion type of products and services with those brands. They both own their own brands, and they're really trying. They've delivered terrific growth over the long term, and they're looking to expand massively in other areas outside the UK, particularly in the US. I mean, in fact, the US is Revolution Beauty's biggest sort of store footprint, I think, at the moment, and it's pretty significant for Boohoo as well. So this sort of tie-up, this strategic investment by Boohoo makes, in my view, makes perfect sense, particularly also that the cosmetics Revolution Beauty are already sold on some of the Boohoo websites. So they do some of the distribution. So they know each other well. It's a really good fit in terms of customer perspective. And it'll be interesting to see how that all sort of develops. But I'm sure Boohoo have seen the strategic logic. And I bet you know, Revolution Beauty see the strategic logic as well. And what it's done, obviously, you know, with the strategic investor, it's pushed the share price up of Revolution Beauty. I mean, it's still massively undervalued, but has pushed the share price up. And on the back of, you know, largely it's taken the tail risk out of that of the stock, because they've still got to publish their full year results on the 30th of August. But what that means, with such a strategic anchor investor behind them, then the tail risk event of sort of like, if there was some, you know, worst case, they had to raise more money, then they should be able to do it with the likes of Boohoo leading the charge in that area. So there's a really interesting development, and it's good that that's happened, because I did say, you know, last time when we spoke about it, that, you know, it's massively been sold off. And you know, Revolution Beauty could well be bought by somebody, or just have a strategic anchor investor to help it through these tough times. And I think both CEOs are absolutely first rate. Adam Minto at Revolution Beauty and John Little at Boohoo. So yeah, it looks very, very sensible to me. Yeah,
a couple of traders I've seen didn't. Well, some hasn't done so well, but I've seen some really jump into REVB. A catch a falling knife trade. It can be dodgy, but when a company gets oversold by so much, normally there's an aggressive bounce, isn't there, initially after a couple of days. Don't jump in too early. The old 3-day rule usually play that well, but yeah, it's sort of more than doubled, isn't it? From it's still, like I say, undervalued here, but it did hit a low of 7.3 pence, and now
well, that was when Jupiter, were the biggest anchor investor at the time, decided to throw out a lot of percentage of their stake, and that didn't help matters into a fairly illiquid market. So somebody dumps it like that, it pushes it down.
So but it's, I mean, that kind of falling knife trade, someone said I saw on Twitter, you know, it's good to go into if you're on small amounts, just but to me, if you did that, if you caught that, like, you know, anywhere below 10,
well, I'm in it now. I'm in it indirectly now. So which I'm doing, which we like.
It's like, you know, in these environments like this, you know, if you see companies that are growing, of, you know, niche markets or the good markets, and you know, you will have companies fall out of bed. They will have, you know, upsets in the trading and all that stuff. And you know, if you're a long-term investor but believe in the business, you can do well over time. You know, I've no doubt 2-3 years in the line, you know, Boohoo be close to back to where it was, you know, but right now the fear is there, isn't it? And that fear gives you discount, you know, but don't go crazy on it, and stuff like that, because you never know.
What's your view of the housing market?
I'm a bit worried about it, really. I think I think if you look, you know, I was looking at some stats yesterday. Actually, I was reading them. I'm just looking across at the American markets first and foremost. So U.S. housing starts tumbles sort of 9.6%. Total mortgage demand hits 22-year low. It's lower than 2008, of course. The pace of UK house prices slows to 11-month low, even though it's still 7.8% up over 12 months. And they're starting. So the problem was the market, wasn't it? It was locked up. The people didn't, you know, there wasn't enough supply. There was plenty of demand, and now they're saying the supply may go up, but demand may ease off. So maybe we'll see some equilibrium. But I mean, depending where interest rates go, I don't know. It's like if people are not getting, the thing is, if you're going to put your house on the market right now and you're thinking, hang on, you know, house across the road got more than this like 6 months ago, maybe people pull their houses off the market. I don't know where it's going to go, but I just think just for rising costs, you know, and mortgages and all that going up, I can't see it being as buoyant, you know, for the next few. It's never going to drop off a cliff, housing market, but I don't think. I don't know. I think it's going to be a bit sticky over the next, 6 to 12 months. I remember seeing someone saying the prices dropped a little bit going back 2 months, I think it was, and Halifax said, no, you shouldn't read anything into this. And I thought, well, no, it's not going to get. I can't see house prices going up massively over the next 6 months because interest rates are going up, and people being squeezed from both ends. So yeah, I don't know. It's what's your thoughts? I know you're on Purplebricks there. What's your thoughts?
Yeah, well, I caught up with the CEO, Helena Marston, before I left, as I mentioned, I'd give somebody an update, and it'd be interesting to see, because even if you've got sort of like prices flatlining or going down, if you get more supply, then this will help the effectively the estate agents. They're the UK's number one digital or online estate agents, and they've been going through some rough times. But the more instructions that get put onto the market, it should hopefully help these guys. But they've got sort of like a really 2 to 3 year turnaround plan, and she's desperately keen to return the business to being profitable and cash generative by next year. She's already done the sort of lot of heavy lifting in terms of the cost base, and the key is now to grow the top line. Part of the actual annualized cost savings was to reduce the national advertising campaigns, and that's happened. It's sort of like knocked the short-term number of instructions coming through the business, say in Q2, but we should see that turning in the second half, and therefore this year is going to be sort of more second half weighted. But obviously it saved them a lot of money, and they're just moving more towards on the digital side of marketing and promotion, rather than these big sort of one size fits all type national advertising campaigns. They've been more sort of like rifle shot rather than actual blunderbuss. So I think she's doing all the right things. I think the management team are sort of like setting the business up. She's bought some shares. The chairman bought some yesterday again, so he bought another, I think it was £260,000 worth of shares, which is obviously a good sign. So yeah, there's still, don't get me wrong, there's a lot of work to do. We all know it's going to be a difficult housing market going forward. But the shares are priced to destruction, so you only need less bad news for the actual stock to do well. And once if they still make 70 million a turnover, well, they did last year, and if they do that again this year, and then they increase the following year, then they'll be able to right size the business to make it profitable and cash generative, and it's going to be worth a lot more. I mean, I would say, just as a sort of like again, one-time sales, put in the cash and the cash burn for this year into that sum of the parts, then you get a sort of like 40, 45p per share type valuation. So I think there's a lot more upside than there is downside, but it's going to be a show me story, and it's going to be a difficult first sort of 6 months. But I had a really good chat to Helen, and I think she's got her head screwed on right. And I haven't spoken to the chairman, Paul Pindar, but there's a lot of self-help measures they can do to correct that business, to right size it. And the key is really going to be to grow the top line starting in the second half, introducing new products in terms of mortgages, conveyancing, simplifying the whole process of buying and selling a house, and they are a lot. It's a lot cheap. If there are more instructions, it's a lot cheaper to sell through them than it is through the traditional agencies. People they need to rebuild that trust with the consumer, and to sort of re-engage with the brand, and make it sort of like more relevant to today's sort of consumer and households, such they do try them out. And I think that's really where we're hoping that the direction of travel is going to be over the next 2 or 3 years.
Yeah, well, I think that's the advantage they have. If they are cheaper than traditional, estate agents, that's going to help, of course. It's hard to know where the market's going, isn't it? I mean, if people were sort of looking to move recently because interest rates are low, the housing market was buoyant, and now they need a mortgage, and they have to spend more on the mortgage stuff. It's I don't know what's going to happen.
Yeah, but the point is that a lot of the stock could still do very well if they get the turnaround right, regardless of the economic backdrop. So, you know, I don't think it's predicated on the macro as much. It's actually really what they do, because they can still win a lot of market share by doing the right things well.
Yeah, no, I mean, there's plenty of people out there, who are moving up mortgages or need a tiny small mortgage, So, yeah, I know it's just at the moment, it's I suppose, again, how much is baked in? There's a lot baked in. The share price has fallen a lot, hasn't it? So, yeah,
there's a lot of bad news baked in. There certainly is no good news, that's for sure.
No,
I mean, let's just say, the chairman just bought over £500,000 worth of shares. I mean, that just says a lot. I mean, that's your scale, that is.
Yeah, I've seen his buys come up, because I do follow them on Vox, and I get notifications when he buys. I thought he's buying a lot of shares.
Yeah, well, and the CEO.
Is that trying to convince people though, or is he can't? What's he know? I don't know. But
well, hey, I mean, if you're trying to convince people, you don't put £500,000 of your own quid in, do you, to convince them? That's a lot of bread, that is, mate.
Yeah.
However's money, but anyway,
well, he's confident then, So yeah.
Okay. Have you been looking at? Yeah, I mean, there's a couple of other stocks I've looked at which I think are really good, actually. Which I've been. One is Fintel, which was the old Simple Biz business, and it is a sort of all things to sort of financial services, to IFAs, to mortgage brokers, and also for product providers like Aviva and BMO and people like that. And what it does, it provides the financial intermediaries with regulatory advice and software. It also provides them with sort of financial services and ratings on particular products, so they can improve their service to their end, sort of like consumers, etc., people who want to invest or get new mortgages, to make it a better quality service. And the whole regulatory stuff has been even more, it's been driven obviously a lot over the last few years by more regulation coming in, but is equally going to be boosted by the new consumer duty regs which are coming out relatively soon. So and they've got sufficient scale that they're really sort of like the dominant player in this whole market, which means they've got these networking effects, and they make really good sort of margins, 35% EBITDA margins. The core business is growing at 5 to 7%. And what really caught my interest, I mean, I spoke about, I spoke to two guys out of Gresham House about this particular business, and they highlighted it. And it's really interesting valuation, because it's on about sort of like 10 times EBITDA, which might seem sort of like not that cheap, but when you compare it against other firms that get bought out, Euromoney Institutional got purchased by, I think it was private equity, a few months back, and they got taken out 20 to 21 times EBITDA, so double it. The shares the market cap's about 200 mil. And I could easily see the share. Well, just on a fundamental sum of the parts, I think the business is worth more than 250p. And on a takeout, and this is a really hot area, sort of all things fintech with very high barriers to entry, good recurring revenue streams, and sort of like retention rates, and they're growing. Then you could see them being bought out at anywhere between £3 and £4, no problem at all. So I would I'd highlight to investors, have a look at this. This is a top quality business that is got significant upside. So if you do have spare cash and you're sort of like a more of a widows and orphans type person, then this is the kind of thing you want to sort of have a really good look at, because it's generating lots of cash, and high profitability, and it's got a good growth trajectory, both on organically at sort of high 5 to 7%, or even high single digits, and it's got M&A opportunities because it's got cash on the balance sheet. It'll have about 10 million of spare cash by the end of the year.
Yeah, but a lot of companies have been sold off, and it's almost like baby in the bathwater kind of stuff, like you said. But I think over the next 6 to 12 months, when you get companies like this, the DAS, I look at that DAS model, distribution as a service, when they get recurring revenues, and you realize, companies aren't, downgrading revenue, they're even upgrading, they're still growing. And that's why recurring revenues in long-term contracts will help these kind of companies. And I think over the next 6 to 12 months, the wheat from the chaff kind of thing, you'll see companies taking a bit of a hit. because they don't have these long-term recurring revenues, and companies that stay where they are or grow. And that's the difference, I think, between the cost squeeze going on. So
yeah, and you could see somebody buy, private equity guy would love this, because you could load it up with debt, in which this is what they do. It'd have high recurring revenue stream, so it'd be cheap, relatively cheap debt, and valuation terms is pretty attractive. So I wouldn't be surprised if somebody had a good look at these and it got taken out in the next 12 to 18 months. And if they don't, then who cares? Because they're cheap and they're generating a lot of cash.
Yeah.
I mean, and then another one I've been looking at, which was actually recommended or discussed with Paul Jordan of Amati, who I really rate, and this is right up your street, just a small cap around about 15-16 mil, is Zenova, which basically is an IP heavy industrial business that has got a lot of patented technology in paints, but particularly fire retardant paints and insulation paints, and it's launched its first 3 products. It IPO'd in November, and it's sort of fully funded to get to basically it's fully funded until it gets cash flow positive, which should be next year. And the advantage with actually its products is clearly when you got things like Grenfell Tower, then buildings need more fire protection. But equally, when it comes to sort of like the climate, housing in the winter is going to need more insulation in terms of keeping the heat in, which is what this paint does. And in the summer, when it gets really hot, then the insulation of the paint keeps the heat out. So it works both ways. So, and they've been appointing lots of distributors, etc., around the world, and lots of people have been taking it. So they've got a good uptake. They've got a good sort of like visibility, and that's just part of the business. The next part of the business is they've developed the liquid from the sort of the paint that puts out all types of fire, so both flammables, electricals, and gas and stuff like that. So rather than having sort of numerous fire hydrants and fire extinguishers, you only need one, which is great, which is again patented technology. This same retardant fluid will then be able to be fit into kitchens as well as sprinkler systems, which essentially is essential in large blocks of flats, as where the Grenfell fire, and also the fluid is used for sort of like to put out bushfires and to protect the wildlife there. So they're really IPO heavy. It's early stage business, but I rate I'd say it's right in your sort of like your wheelhouse of sort of 15 mil high growth and really good distribution around the world. And if you're just doing the numbers, you're looking at sort of like a 3p EPS if they get to profitability in about 18 months' time, and you put a 20 times multiple, you get 60p share price, and they're currently less than 20p. So you've got a lot of potential upside there out of a really high IP type business that could get bought out by one of the big paint manufacturers, likes of, I don't know, Axel Nobel, PPG, or sort of like any of the other. There's a big industrial, I can't remember what it's called out in the States as well. So one of the big sort of like paint guys could definitely take this on board.
Yeah. No, I talked to at the IPO actually, Tony, the CEO of this company.
Oh, did you?
So,
okay.
Yeah. So it's very interesting, and worth going on their website to see. They've got video demonstrations of their products in action where they just set fire to stuff. Two can.
That's
for
great.
example, they have a can of a can of Coke, whatever, and they cover theirs and they just set 200 degrees flame on one, and it's no damage done to the one with their coating on it. But it's nice, and also they to see this being used on sets at Pinewood Studios as well. So when you get sort of big industry building, and again, that's another one is trend. You've seen, bushfires and all that happening, and we've seen this. If you believe in climate change, and they say there's an amazing stat, I forgot it, but I think the 10 hottest years have happened in the last 2 decades, something ridiculous. So the trend is, you see, hotter, summers, colder winters, so extremes happening. So if you believe in that, and you believe that more fires are going to happen, this kind of stuff plays into that trend, isn't it? And the fact
and it's pretty unique technology as well. So I mean, the shares could move a lot positive, could really move higher over the next 6 to 12 months. Once, if they continue to start sort of like, appointing, can you do appoint distributors, and there's some good news, contract news associated with it, and you can really see it, doing very well. So again, it's more, you've got two there. You've got more of a sort of like a sort of a widows and orphans stock in Fintel, which is solid, really, really solid, already generating lots of cash and margins. And then you've got something which is obviously a bit more upside, but fully funded and very high IP. So, you sort of, you choose what type of stocks you like, or even both.
Yeah. Cool.
Have you been having a look at any at all? Or would you sort of like, other than the ones you've obviously got?
No, I mean, I do go through stocks even for my sort of weekly webinar. I go through many stocks results and stuff, but at the moment, no, I'm just, I'm happy with what I hold. I don't have much spare cash, but I just generally look at the moment. I said last on the webinar, if you're looking at stocks, try and get companies that are insulated from the costs going forward, or they solve a problem, in going forward. Like I said, with Crestchic or eEnergy, I have recurring revenues in some way, long-term contracts to get through this, because I think in many companies, of course, financial results come out, they are delayed anyway, but I think we'll see over the next 6-12 months some companies downgrading a little bit. But
yeah, I mean, what two other big stocks you might want to have a look at there, Justin, if you want to get a bit more solidity in your portfolio, is, we mentioned it before, Moneysupermarket.com, which is right in the space, the cost of living crisis, helping people save money, etc., and they're still relatively cheap. And then the other one I would suggest people have a look at is TP ICAP. ICAP, because it came out with some very good results only whilst I was away, and they're the world's number one sort of, or one of the biggest broker intermediaries, and they, particularly in interest rates, and then we see how much interest rates keep going up and down. Well, that volatility plays to these guys, because the more volatility you get, the greater the trading, and likewise with the oil and gas industry. And the shares have been, brutally sold off. And again, they've rebounded strongly, but that's a good volatility hedge. So again, those two types of stocks, I would say, in this current climate, will continue to do well, and they're cheap. So, put the slide rule over Moneysupermarket.com and TP ICAP, and they're reasonably big businesses. One's, I think, TP ICAP is 1.2 billion, and Money Supermarket is 1.2 billion. So, they're reasonably sized, chunky businesses that is good, solid upside.
Yeah. No, I did look at Money the other day, actually. Just put through my spreadsheets there, and decent growth at the half year, wasn't it? 19% top line, or the 3 times sales there, 11 EBITDA EV. Yeah, it's looking good. And I think the chart looks nice on it, actually. If you look at the chart on Money, it's starting to bend around a big upside, but I mean, it's starting to look like it's hit the bottom, and so it could recover nicely there. But yeah, no, I'm literally, I always look around, but I'm it's just having like a cash ready. But there you go. That's
well. Anyway, so have a good holiday. Go to the west of Wales with your family, and come back in perhaps hopefully in a bit more positive mood, with a better sort of rosier view.
I'm listening. You've got to be an optimist to be fully invested. I am.
I agree. Totally,
I'm just saying that there's, because I see people on just 80% in cash. I thought, well, what's the point of that? But whether you're telling the truth or not. But I just think there will be a bit of volatility. But I said if I'm looking 3 to 5 years on the line, or whatever, it's going to be fine. It's just over the next 6, 12, 18 months maybe. It'll be a bit sticky. I don't think this is the bottom. I think it may go a bit lower. And then, of course, the best returns is off a bottom like that. And so we're not far from the bottom. So you can't not be uninvested here. You're never going to pick the bottom, So I think there's more reward over the next 5 years than there is risk, pretty much from where we are. Marvelous stuff. Cheers, Paul.
Take care. Cheers, guys.
Cheers, buddy.